Fund update call, September 3rd, 2025. Welcome, Matthew Todman, Omar Khan, and we're going to go over exactly what's going on in the markets, what we're doing, and how we're going to play this little seasonality period. We are in, like I said, the nitty-gritty of summer, and it's not the best time of the year. So how exactly are we going to play this? What are we going to do? We're going to go over all that stuff. All right. So we're going to talk about a couple things here. How we're doing, of course. The current landscape, stock rotation. So generally speaking, stock rotation, what does that mean? Well, that means for a large part of the year, the technology stocks have dominated the actual performance area, okay? But stock rotation means when people start getting out of those high performing areas and moving into other stocks. And that's been happening, especially in August, okay? So we're going to talk a little about that. Our outstanding positions and what to look out for the next few weeks. So September and October, like I said, are not the best, okay? So the NASDAQ gained 1.65% this in August. And the Russell 2000, which are the really small companies, Russell 2000, that's 2,000 companies. It went up 7%, 7.14%. This strongly suggests the stock rotation may currently be underway. So you can see the NASDAQ, which has been leading the way, the technology stocks which are leading the way, have not been as much in terms of leading the way on the latter half of the year, or at least at latter half of August, latter half of summer. Now, the iShares Russell 2000 ETF, that has done really well. Those, like I said, are the really small companies, okay? One of the reasons could be the investors rebalancing portfolios. And people generally know that September and October are not the best months. October is more flattish, but September is a terrible month for the stock market in general. So what do people do in anticipation of that coming up? Well, they rotate out of the high-flying, well-performing companies, and they go into other companies, okay? Now,
I
one
mean,
of the things...
the other part to that is that, this is an interesting phenomenon. Like, this is not a risk-off environment right now. This is actually more of a, risk-on and then more risk-on environment, because the smaller cap stocks are usually associated with, a little bit higher risk in terms of how they perform, because they're just simply smaller guys. The smaller the company, likely the greater the risk, generally speaking, right? So it's not like, oh, the tech bubble has burst and that's it. It's like, no, the investing public are seeing other opportunities in small caps, at least in the month of August. We're not saying this for every month, but this is exactly what sector rotation is. Sector rotation can be between, like, let's go from, cyclicals to financials, or financials to discretion and da-da-da, or it can be, into small caps. Now, there is a theory out there, and I don't think it's, without its grain of salt, is that this is an anticipation of a rate cut coming in September, meaning a lot of these companies, when you are starting out, you are levering yourself up quite a bit, and a 25 basis point cut coming in the month of September could actually give you some more oxygen in terms of cash flow, and you might be then on your way. So
Matthew, why do the smaller companies perform well in anticipation of rate cut versus larger companies? Why is that?
Well, generally speaking, they're more, a little bit more debt laden, right? So if you have, say you have $1 billion worth of debt, and rates go from 5% to 4.75%, well, that's significant, right? That's 25 basis points on $1 billion. That's $25 million, right? It's not nothing. It's a good chunk of money, and that can be used for operations, expansion, et cetera, right? So you name it. So there is that type of thing. So I think, the risk appetite is still in the air there. Like, people still want to take on risk, and I think there's more upside down the road in this kind of current environment than down. Certainly this AI stuff, people are saying that we are at the beginning of these disruptive technologies. And when I say that, I'm going to include, like, artificial intelligence. I'm going to include electric vehicles. I'm going to include certain energy. I'm going to include chips, et cetera, right? And they may all be linked, but they are, in fact, like, they have their interdependencies. But that being said, they are all different industries, right? So yeah, that's what we saw in the month of August. It was sluggish for the NASDAQ. But this is what happens sometimes. Uh, and I think that it's a nice prelude to what is coming in September. And then the third week of September, we are going to have a Fed rate announcement. The last time I checked, about a week ago, I've been away for a week, is that about a 95% chance has been baked in that there will be a rate cut in September. And any surprises to that is going to be, providing some headwinds to the market as a whole, right? So, that
Yep.
being baked in, I think that we saw a little bit of a run up in the small cap sector, right? Okay. And yeah, here we are. This is exactly it. This is, you may hear this, the Fed has been colliding with politics for a long time now, and certainly as of late, even more so. And uh, theoretically, these are separate entities, and even in fact, they're separate entities. And the president, John Davis in the South, he wants to kind of commingle these a little bit. And so we'd hope that there's no kind of influence there, but you never know. But regardless, this is what the numbers say, and I believe that's what, 90 something. I can't see that small print on the screen, but
Yeah, it's
it's like
86
90
versus
10.
14.
Yeah, okay, 86-14. That's pretty good odds for me. Now, where the surprises will come, guys, is that if there's no rate cut, if there is a larger rate cut, which I think is a very, very, very small percent, I don't think that's going to happen at all. Or if there is rhetoric around, hey, this is it for a long time, or basically dovish rhetoric to say, listen, we're not taking these rates down, or like we're not going to do this kind of stuff. And if the two things could derail this: a numerical difference from expected, or a verbal difference from expected. Those are the things that could derail this. Other than this sets forth what very well happen in the third week of September.
Yeah, the economy in the United States, like in Canada, is not doing very well. So almost highly likely we are going to have a rate cut, 86%
Yeah,
percentage. Now, if it doesn't happen, the market probably won't react very favorably. And if we get a more of a rate cut, which again, highly unlikely, the market will probably react very positively. If we just simply get a rate cut as anticipated, well, the market just kind of goes on as anticipated. Okay. So let's keep going here, Matthew.
absolutely. So, um, here we have, we talked about the Russells, the Russell gaining here. Are there some doubts about AI? Yeah, but there's going to be doubts about every disruptive technology, or cutting edge technology. We are talking about even in small companies like Theta and Fortran and whatnot. We used to talk about AI like literally on a daily basis. There are companies across the landscape that are talking about AI, and there's not one person in my network of colleagues and friends that are not attuned to this to some varying degree, but are very well aware of AI's ability to make processes more efficient, to reduce headcount, and also very likely increase their top line as well, right? And we've seen this on the ground level. We've seen this at the very highest level with the likes of, like, there's a certain irony when you have Microsoft, who is a partner in ChatGPT, then laying off people for the very product that they helped invent, right?
Is that crazy?
There's a certain circular irony there, right? And yeah, I mean, it's interesting, right? If you're working at one of these companies as an engineer, and it's like, you're working in the AI thing, and suddenly you've AI'd yourself out of a job. That's
Yeah.
uh that's a strange position to be in, right? It's happened before, though, right? Like when you have engineers that work on lines, and they make the engineering so great that they don't need to be there anymore. Well, this is happening this in a different form these days, right? So that being said, I think there's more runway, and I think there's obviously more runway on the AI front there. Um, you know, some analysts contend that potential revenue from AI efficiencies could reach 1 trillion annually. Others remain cautious. Guys, like, honestly, like, do we know where this is going? We know, it's like you know how to get to Northern Ontario, but do you want to take here Ontario? You want to take the 410? There's different routes to get there. How long it'll take, we don't know. How much it'll cost you, we don't know. We don't. so we know the general direction. I'd be a little skeptical of the 1.5 trillion. Could be much more, could be a little bit less. I don't really know, but that is kind of a number that is put out there. We've talked about the other 2 points in terms of AI being very good and very bad, and we also talked about the last point about rate cut favors small companies, and because of that debt load, this actually matters to these small companies. Let's continue to the next slide, please.
Mhm.
So September seasonality. If
Worst
you're
month
sitting
of the year, Matthew. The worst month of the year, historically,
worst month of the
anyways.
year, I've been trading for a very, very long time, and now in the theta alpha portfolio, and September is it's one of those months which you're really just kind of walking on eggshells a little bit, and that's just the reality of September, right? Like you have historically you could have had like a low volume summer which bid up prices a bit too much, and the masses come back and say no, let's kind of fair value the market a little bit better and sell off some of these positions. We do see that. And indeed, we did see that just yesterday, the first trading day of September. Today, we saw a little bit of a bounce back, but it wasn't a crazy bounce back at all, right? Certain stocks did better than others today, guys, but like it wasn't a crazy bounce back. But don't forget, we are 2 days in, and I think there's 20 trading days this month. I'm not too sure, but there'll be between 20 and 21 trading days, generally speaking. And there's a lot more trading time to come. About 90% is left of the trading days in the month, right? And
Look at reasons why. Why
why?
exactly?
Well, I mean, the first one we've kind of talked about. Period often brings a pause in spending as best pay off vacation bills. I just came off my vacation and I looked at my visas. Got to address that this week, right? And I'm sure I'm not the only one, right? People going to cottages, et cetera, et cetera. Yeah, there's some pulling back there.
Yes,
Absolutely.
please.
Hmm?
Nothing. I was just saying.
Rebalance portfolios. Absolutely. Rebalancing, you can say rebalancing happens quarterly or monthly, but portfolio management, at least if it's active, guys, that may be happening much more frequently than monthly or quarterly, right? So and companies come in and out of favor, and you have to be aware of that. And like especially if portfolio managers think price has been bid up and they want to take some risk off the table, you might see that as well, right? Tax loss harvesting, that's a point. And now might be a good time to start tax loss harvesting. And at least get the idea out there, right? As to what you're looking to sell into the last few trading days of December. But that conversation could start, right? All right, let's continue on. Here you see, so negative returns 55% of the time compared to 39% for all other months. 40 worst monthly losses occurred in September, more than any other month, right? Now, these are not like exceptionally compelling statistics, but like if I'm told 55%, you are right. So that are going to proceed with caution, right? And the third line here, barring September 2024, SP rose 2%. The index has declined 4 of the past 5 years, right? And I like these types of statistics, guys, because the stock market simply isn't the stock market like 20 years ago, 10 years ago isn't the same stock market it is right now, right? Or that it is right now. So, but when you look at the last 5, this is why you have kind of oftentimes when you do analysis, you kind of concentrate on the more recent years of the past rather than years which are like 10, 20, 30 years ago, right? And we see 80% of the time it has dropped average of 4.2%. So like in terms of our own theta alpha portfolio, yeah, we're overlaying with some covered calls, much more heavily in these first few trading days, and we're going to look to execute on
And
that,
holding some more cash too, Matthew, right?
and holding some more cash as well.
Yeah.
So to do 2 things, right? To buffer some of this potential loss that may occur, right? And number 2 is to be able to capitalize on relatively cheaper assets in our perspective, right? So it's kind of twofold, and you'll see here, like between 2020 23, wow, 3.9 to 9.3% down in the last few years, right? So these are these are things that you can't ignore here, guys, right? So is it a good time to kind of have some cash on the sideline, keeping warm while you wait to deploy? I think not such a bad idea, right?
And that's exactly why we're doing it. We're keeping cash on the sidelines. We're writing covered calls because we know that historically it's no guarantee. but we know historically that this is not a very good month. And also October, the beginning of October, also not very good. But as you can see, October obviously is a lot better. But September is by far the worst month of the year. So that's exactly what we're doing to combat it. Now, it might not work out in our favor. It might. Writing a bunch of covered calls, collecting some premiums, which is very nice, by the way. But if the market rallies, we may get called away in some positions, but we're okay with that. We're okay with that. The idea here is to go with the odds and probabilities. And the odds and probabilities suggest that we go heavily into or more heavily into cash and write covered calls, which is exactly what we're doing. Okay.
Okay, let's go to the next slide here. So here we see like, this is not a North American phenomenon really, right? This is more of a global phenomenon. Like look at the look like US, UK, Canada, and Hong Kong, all traditionally kind of, now this is back to what, 1970 you're saying?
Yeah. 50, 55 years.
Yeah, 55 years. So I mean, like, you take it with a grain of salt, but like you have to notice these things, guys, and we need to prepare ourselves around that. And if we can hedge ourselves a little bit by writing some more calls, by all means. We are, in the fund itself, we're in the fortunate position that generally speaking, we have unrealized gains. So writing calls right now is decent for us. Excuse me, it's decent for us. So we're okay in that predicament. Let's go to the next slide, please.
Mm-hmm.
Uh,
Volatility,
obviously,
Matthew. Volatility.
yeah, I mean, like stocks go down, volatility goes up, right? Uncertainty definitely goes up on that perspective, right? Um, so yeah, I think if asset price is going to go down, uncertainty is going to go up, volatility is going to go up. It plays into our investment thesis quite well. We are totally fine deploying excess cash when volatility is high. We are okay doing that. We can't be afraid of the red. We should get shirts that say, "Don't fear the red."
Yeah.
Uh,
Well, long term, we believe in our positions, right?
yeah,
The
absolutely.
idea is the idea is simple that September is not a great month. In
No,
anticipation of that, we're writing covered calls, we're holding cash, but if we get assigned a bunch of positions and we have to buy a bunch of stocks during September, we're totally fine with that because we know what's coming next or what has historically come. October, December, excuse me, the S&P has generated an average gain of 4.2% and finished higher 80% of the time. So we know that
yeah,
this, the whole sell in May and go away thing ends in the first week of October. And if it ends in the first week of October, we want to be prepared for that. How bad will September get? It might not get bad at all. It might be positive. Who knows? But we have to play the odds and probabilities, which is exactly what we're doing. Okay.
exactly. So yeah. And guys, like this is like this investment. This is a higher risk investment, as you guys have all been notified of during your KYC and suitability calls and whatnot. And we are invested in technology stocks and stocks that interconnect with technology, right? So they're going to have I would say that there's more volatility, but not necessarily more risk, if that makes sense, right?
Yeah.
Let's continue on here. So this is these are some charts. You can see that we are at the top of the trading range. Maybe there's a little room for a pullback here. And yeah, like, you see some indicators here that may uh, come before a little bit more of a downturn. But at the end of the day, guys, these charts are one thing, and there's several inputs into the stock market, right? Fundamentals, technical, seasonality, global news, economics, et cetera, et cetera. This is one of them. And we take this into account as we are executing our strategy. Can you go to the next slide, please? Yeah, so, the NASDAQ did hit some resistance a little while ago. And, resistance is one of these all-time highs, guys. This is indeed a double-edged sword, right? It is a double-edged sword. I'll explain why, right? On one hand, you'll say, man, how much higher can this index go? It's bound to fall, and that's a very legit issue, right? You're in a new ground here, new highs. You don't know necessarily where things are going, and human nature will say, obviously it's gone too high, it's bound to fall. However, from a psychological perspective, the best indicator of an all-time high
Is an all-time
is
high.
an all-time high. Like, how do you get even higher if you haven't gotten higher before, right? And that's the reality of it. So it depends. Like, are you going to put on your optimistic hat or your pessimistic hat? I would say that both are valid, but then I think we all need to search for other reasons to support our conclusion. So I'm okay with these being all-time high. Do I think there could be a downturn in the market in the month of September? Yes, yes, maybe so based on the data. But do I think that the Nasdaq has breathed its last air of bull energy? No, I don't think that is the case because of the new technology that we are literally living through.
Yep, and we're preparing for that. Like we said, we're raising cash, we're writing covered calls, so we're preparing for that. If we get called away, we get called away. We're fine with that. But we're going to play the odds and probabilities. Long term, obviously, we think our stocks are going to go a lot higher.
Yep.
However, in the short run, they could go lower, and a high likelihood that September would be the month where it occurs. Okay, so our portfolio, what do we hold? As you guys know, we started adding a position called Constellation Energy recently. And why Constellation Energy? Well, Constellation Energy is a company that provides nuclear technology, nuclear reactors. And we know that in order to fuel the artificial intelligence revolution, the whole artificial intelligence era, you need a lot more energy. So we've taken a decent position now that in 2.6% here, as you can see. We'd like to get up to 4%, but we're only at 2.6%. Everything else, if you look at Alphabet, we're pretty much in line. Amazon, we're pretty much in line. Alphabet, by the way, or Google, had a great day today. We are lowering our Apple position slowly. And the reason why, as we mentioned earlier on, is because we just simply find that they are not innovating and they're not moving the ball forward like they used to. Now, Microsoft were a little bit underweight, sorry. Same with Tesla, a little bit underweight. AMD were pretty much in line. Meta, a little bit underweight. Eli Lilly were a little bit overweight. And the reason Eli Lilly were overweight is because we had a great opportunity to buy. The stock did go down a decent amount. And so when it went down, we were able to buy a decent chunk. Taiwan Semiconductor pretty much in line. NVIDIA pretty much in line. Bitcoin pretty much in line. Like I talked about Constellation, we're a little bit under. And as you can see, we're at 94.8%, and our desired exposure obviously is 100%. So what does that mean? It means we got a bit of cash on our hands, okay? So we have 6.5% cash on hand, and luckily for us, the good thing is our investors continue to invest more and more capital with us, so we have more money coming in all the time. And that additional money allows us to be able to keep adding to this cash position. So all the money that's going to be coming in September, we'll probably keep it as a cushion and keep buying in anticipation of lower prices. Now, again, that may come to fruition. It may not come to fruition, but what we're going to do is play the odds and probabilities. As terms of performance is concerned, how are we doing? Well, we're up 7.05%. Now, this is net of all fees. And this is as of August 29th. Okay. Whereas the market, meaning the NASDAQ in Canadian dollars, is up 6.53%. And your goal as an asset manager is to beat the market. That's the goal. Each and every year, what you want to do is you want to beat the market. So far for us this year, we have beaten the market, and that is something we'll continue to look to do. Anything to add here, Matthew?
No, well, yeah, I would say that. I mean, I'd say I don't think it's the goal of every asset manager to beat the market. I think it's the goal of every active asset manager to
Agreed.
beat the
Agreed.
market. If you're running a passive like bond portfolio or income portfolio, maybe that's not the case. But like running an active strategy here, our goal is to beat the market. But again, like beating the market is just a crazy thing, right? Like we could very easily beat the market on as I said, I actually had the call this morning. Like, we could it could be very easy to, not easy, but it could be very likely that we beat the market on like, a January 1st to January 5th of the following year time period. But like, in the present day, you are clocked from January 1st to December 31st. If you beat the market of the period going from January 1st, 2025 to January 6th, 2026, it doesn't matter because those numbers don't get reported, right? So, we are looking to beat the market on every day possible, right? But definitely in the long term. But in the short term, we look to beat the market on every day that is possible within our risk framework. We're not going to take on a whole bunch of risk so that we can beat the market, because that is playing with fire, and we are simply not going to do that. We believe that the options overlay and our security selection is providing sufficient risk to achieve our goals. Okay.
So, obviously, guys, you guys know all about the fund. For those of you guys who've been paying attention and invested with us, here's the management fee, the fund code, the risk management portfolio in terms of investment term. With an investment like ours, you have to have a long-term time horizon, because these type of stocks can go up and down quite a bit in the short term. Meaning the technology stocks, artificial intelligence companies are the ones who are going to benefit from it. They can go up and down a lot in the short term. However, the trade-off for that is hopefully long-term outperformance or long-term significant gains. Now, what to look for in the next coming months? Okay, so we know September is not a good month. Okay, but let's take a look at what happened.
I really hope it is. That being said, I'm not hoping for a downturn yet. I still want, but I'm saying I'm preparing for it, right?
Yeah, we're preparing for it.
Yeah.
But we're not looking for it. We obviously would like a positive month, but we're not counting on it, because we know historically, and you look at this, okay, since 1950, since the past 20 years, the past 10 years, and election years, although this year is not an election year, you can see the market is, out of all months, it is the outlier, right? So what do? Again, you sell covered calls and you hoard some cash, and you look to deploy that cash, because what's coming up next, okay, is some pretty good months. October, November, and then we have the Santa Claus rally, January, February, March, April, all the way till early May. These are the best months of the year, and they're just around the corner. We just want to get past this September period and see how that does. But September has been pretty poor historically. But we are, again, anticipating some interest rate cuts both in the United States and in Canada. And for all you real estate investors out there, that will impact you as well. And that here, Matthew?
No, that's about it.
Okay, guys, contact information. So myself, you can see here, love to hear from you. My contact information here, Matthew's as well, and the president of Corton Capital, David Jarvis. His information is there as well. Please contact any of us if you have any questions whatsoever on the portfolio. And always, there is the obligatory disclaimer. Please read it at your leisure. This will be available for replay, and you should see it. And also, it'll be up on YouTube shortly after it has been scrubbed by our compliance department to make sure that we have said nothing offsides. But this is the standard,
which we haven't, but it is appropriate protocol for compliance to review and approve prior to publishing this in the public domain on YouTube. But yeah. Okay.
All right, guys. Thank you so much for joining us. Yeah, have a great night, and we will talk to everyone soon. Take care.
Bye.